In a landmark decision, Turkey has announced it will bring an end to its foreign exchange protected deposit scheme, widely known as KKM. This program, which was introduced in late 2021, was designed to shield Turkish lira deposits from sharp currency fluctuations by offering protection against exchange rate losses. The move marks a significant shift in the country's economic policy, signaling a departure from unconventional measures that have defined recent years. According to the central bank, no new KKM accounts will be opened or renewed after August 23, 2025. This deadline gives both banks and depositors time to prepare for the transition and adjust their financial strategies accordingly. By phasing out the KKM, Turkish authorities are aiming to restore confidence in the lira and return to more orthodox economic principles, such as inflation targeting and transparent monetary policy. For several years, the KKM scheme was a key tool to stabilize the lira without resorting to aggressive interest rate hikes. However, the program became increasingly expensive for the government as it had to cover the widening gap between the lira and foreign currencies, leading to mounting fiscal costs and market distortions. Ending the KKM is expected to help normalize monetary policy, reduce the fiscal burden on the state, and encourage Turkish citizens and businesses to rely less on foreign currencies, a process known as de-dollarization. Importantly, existing KKM accounts will remain valid until they reach maturity, ensuring that depositors are not caught off guard and that the transition is as smooth as possible. This carefully phased approach is designed to prevent sudden shocks to the financial system and allow both markets and individuals to gradually adapt to the new environment. As the KKM era comes to a close, economists and investors are closely watching to see how Turkey will maintain financial stability and manage inflation without this unique instrument in its toolkit. The world is watching as Turkey embarks on a new economic chapter, with hopes that these reforms will pave the way for a more resilient and sustainable future. The KKM scheme was born out of a deepening crisis in late 2021, a period marked by extraordinary economic turbulence in Turkey. The country was facing a perfect storm. The Turkish lira was in freefall, losing value at an alarming rate, and inflation was spiraling out of control, eroding the purchasing power of ordinary citizens almost overnight. As the lira plunged and inflation soared, daily life became more difficult for millions. Prices of basic goods skyrocketed, and uncertainty gripped the nation. People watched their savings evaporate, and businesses struggled to plan for the future. Unorthodox policies, most notably cutting interest rates despite rapidly rising inflation, triggered a widespread loss of confidence in the lira. This led to a rush for foreign currencies, especially the US dollar, as people scrambled to protect their wealth. Dollarization accelerated at an unprecedented pace, deepening the lira's decline and putting even more pressure on the financial system. The government urgently needed a way to halt this downward spiral without abandoning its commitment to low interest rates, which it believed would stimulate growth. KKM, or the Currency Protected Deposit Scheme, was introduced as a lifeline. It offered savers a government-backed guarantee against currency risk, promising to compensate them if the lira depreciated further, and thus aimed to keep money in lira accounts. The scheme was a high-stakes gamble, designed to restore trust in the currency and stabilize the financial system, without the politically unpopular move of raising interest rates. In reality, it was a temporary fix for a crisis largely created by policy missteps and a reluctance to use traditional economic tools. KKM emerged in an environment where conventional solutions were sidelined and uncertainty reigned supreme. Investors, businesses, and ordinary citizens alike were left guessing what would come next. The program was a direct response to a self-inflicted crisis, a desperate attempt to patch up the damage rather than address the root causes. It was never intended as a long-term solution. Ultimately, KKM was a bandage for a deep wound in economic confidence, a short-term measure to buy time, but not a cure for Turkey's underlying economic challenges. The FX Protected Deposit Scheme, known as KKM, was introduced as a bold move to stabilize the Turkish lira. It allowed both individuals and businesses to open special lira accounts, but with a unique twist that set them apart from ordinary savings accounts. Savers earned regular bank interest on their deposits, just like with any other account. But the real innovation was the government's promise. If the lira lost more value against foreign currencies than the interest paid, the state would cover the difference, making up for any extra loss. This guarantee made KKM highly attractive to depositors, especially during times of economic uncertainty. However, it also meant that the government was taking on a significant financial risk, which could become very expensive if the lira kept falling. The structure was designed to encourage people to keep their money in lira, rather than rushing to buy dollars or euros. By doing so, it helped reduce the immediate pressure on the currency and slowed the pace of dollarization in the economy. However, every time the lira depreciated further, the government's liability grew. The more the currency weakened, the more the state had to pay out to depositors. In effect, the scheme shifted the risk of currency depreciation away from individuals and businesses, placing it squarely on the public purse. This meant that taxpayers ultimately bore the cost of protecting savings from currency swings. While KKM did help slow down the rush to foreign currencies, it also created a massive and unpredictable fiscal burden for the government, making future costs difficult to estimate. The overall cost of the program was directly tied to the lira's volatility. The more unpredictable the currency, the higher the potential payouts from the state. In many ways, KKM functioned like a synthetic foreign currency account, but with the crucial difference that the government, not the banks or depositors, was responsible for covering the losses. Ultimately, this precarious setup was never meant to be a permanent solution. The mounting fiscal risks and unpredictable costs made it clear that KKM could not last as a sustainable policy for Turkey's economy. The KKM scheme was launched amid historic lira weakness. In 2021 alone, the lira lost 44% of its value against the dollar, triggering the crisis. Depreciation continued, 29% in 2022, 37% in 2023, and another 16% in 2024. The government's low-rate policy fueled negative real interest rates, driving savers to foreign currencies. KKM payments ballooned as the lira kept falling, straining public finances. The scheme masked but didn't solve deep economic imbalances. It transferred currency risk to the state without addressing the root cause: lack of confidence in policy and the lira. KKM treated the symptom, not the disease. KKM's success in attracting deposits came at a steep fiscal cost. The government's guarantee meant every lira drop increased payouts to savers. Since 2021, the scheme has cost Turkey an estimated $60 billion. This unpredictable expense strained the national budget and diverted funds from essential services. Financing KKM payouts fueled inflation and undermined stability. Critics argue the scheme monetized currency losses, creating a vicious cycle. Ending KKM is about stopping this fiscal bleeding and regaining budget control. The long-term costs far outweighed the short-term benefits. KKM was initially popular, peaking at $140 billion in deposits. As orthodox policies returned and interest rates rose, traditional lira accounts became more attractive. Savers shifted away from KKM and deposits plummeted. By the scheme's end, only $11 billion remained, a 90% drop. The government made KKM terms less appealing, encouraging this transition. The sharp decline made winding down the program less risky. The market had already adjusted, softening the impact of the official termination. The phase-out was anticipated, not a shock. The groundwork for a smooth exit was laid well in advance. Ending KKM comes with major changes to banking regulations. The central bank is scrapping rules that once incentivized banks to promote KKM accounts. New regulations now reward banks for growing standard lira deposits. The goal: complete de-dollarization and normalize the banking system. Banks will now make decisions based on market logic, not government quotas. This regulatory pivot aligns incentives with price stability and financial normality. Removing artificial incentives should lead to more efficient capital allocation. The revised rules provide a clear roadmap for banks in the post-KKM era. It's a technical but crucial step toward a stable, market-driven economy. Ending KKM removes a massive fiscal liability, improving Turkey's budget outlook. Freed-up funds can now address other economic and social needs. The main risk: some remaining KKM deposits could convert to foreign currency, pressuring the lira. The central bank must manage this transition with careful use of reserves and interest rates. In the long run, removing KKM should lead to a healthier, more market-driven financial system. The economy will rely on credible monetary policy, not costly guarantees, to stabilize the lira. Success depends on continued commitment to orthodox policies and inflation control. Ending KKM is necessary, but must be paired with broader reforms. If managed well, this could be a turning point for Turkish economic stability. Ending the KKM scheme marks Turkey's return to orthodox economic policy. The program was a costly experiment, shifting risk to the state and distorting markets. Its end signals a commitment to sound money, fiscal discipline, and credible policy. The immediate challenge is unwinding remaining deposits without sparking volatility. The central bank must use conventional tools to maintain stability and build credibility. Long-term success hinges on fighting inflation and pursuing structural reforms. This bold step closes a chapter of unorthodoxy and opens the door to stability and growth. Turkey's future now depends on steadfast implementation of these orthodox policies.